Okay, now I open the random chart again. I mean, we can still open another random chart. Let's load it. Okay, perfect. We are in the year 2020, around April. This is the price action right now. This is the daily chart. How can we combine the higher time frame with the lower time frame? What does that mean? Basically, what it means is, let me draw something. When you look at the higher time frame, okay, when you look at the higher time frame, and now zoom into this section, it will most likely look like this. Yeah. The higher time frame is always smoothing out the noise. Okay. What does that mean? That means if you get an insight of what's happening around the higher time frame candles, could be daily, could also be weekly or 4 hours, but I wouldn't go lower. You can see the momentum of the lower time frame. Means if the candles are clean, clean candles with big bodies and very small wicks, that means that the lower time frame is going crazy. Okay, like that. Depending on which lower time frame you use, I wouldn't use a 4 times smaller than 4 times. Means when you're using a 1 hour, you should easily trade on a 50-minute chart. When you use a 50-minute, 5-minute wouldn't make such a big difference. So you could go to 1 to 3 minute charts. At least 4 times, but even bigger would be better. Why? Because then one candle summarizes the needed time so your momentum trades can work out efficiently. For example, on this case, when you see this one, and let's say this is a higher time frame, we are at the moment at a higher high, and we have no other points where we can look at, no past structure points where we can see what's happening. Then you should always go with the trend in two different ways. You have the aggressive entry and the passive entry model, but we will talk about them in the next few videos. The passive means, just in short terms, you're waiting for a pullback before going in, while the aggressive entry model just says you're going into a breakout. Okay? And now look at this case. Where right now, man, it looks nearly the same what I draw. Let's compare it. Where is it? It's like here. We're pushing up, solid retracement, and we're breaking the highs. In this case, we didn't break him yet. But let's see if we will break him. If yes, we're going into the direction. So means we could make after the higher high around here just a continuation trend. 101 aggressive entry style. So we broke it, you see. Now we made a big bearish candle. And we got stopped out in this case. and now let's move to the direction. So the direction was correct, the movement was correct. The only thing which caught us was the entry. As you see, on the aggressive entries, you are saying you're going for a straight or a strong breakout. In this case, the passive entry model, after a retrace, doesn't matter where, will be the winner. But the question, when to apply passive and aggressive entries. As I said before, the aggressive entries, you're going for strong moves where you expect strong volatility in one direction after your entry point. On the passive one, you're waiting until the price touches a zone back into the liquidity. Means we're testing, for example, demand or support zones, or in a different case, on the opposite movement, we're testing resistance or supply. What are the negative points of each? On the aggressive one, it is you can get stopped out really quick by just a pullback. What's the negative side of the passive entry? You can miss entries by waiting. What does it mean? Let's say there's a move like that, and you're saying I'm waiting for a pullback into the last demand zone area where I can go long, but instead the price doesn't go back and continues higher and higher, and you missed out the trade. The question, what should I use and when should I use it? And that is a purely individual question, because everyone has a different likelihood of going into risk or playing it slow. When you ask me, I'm using both depending on how I read the price. But now let's go back to the lower time frame, because we will talk about this both trade entry models later on. When you have the higher time frame move, as I drawn like that, let's say this is a daily chart, you should know around here, even if the price looks like we're falling downwards, we are not. Again, this is a higher time. When we break a higher time frame, most likely the next few pips will go into the direction, because again, we are scalpers. Even let's say on this example, just look at this. Even when we just break this high right here and just form a candle like that, and then moving downwards, this move alone and the 1 minute chart, on the 5 minute chart, or a 50-minute chart is enough. It doesn't look big or huge on the daily, but when you zoom in, bro, it's a lot. Right here, this is on the right side. When you look, it's a $9 move on gold. It's a lot. Okay, let's go to the lower time frame. As I told you right now, on this scenario, I would 99% go long. Even if you wick down, it is what it is, because you need to follow an edge. And the edge is formed by a lot of data, by a lot of practice. In my case, all the work I've done, all the hustle and all the experience, I melted together into my understanding of the chart and price action movements. So in this case, for me, this is a clear long on the scalp. Let's go into the 5 minutes. Okay, that's how it looked like. It's because I think of the broker, but I would go long here. So let's put the trade here. Okay, we need to change the broker after this one because it really looks like a weird wicks. So you get my point, right? I mean, yeah, now a few days went past, but this is right now just about the price action, okay? And this reading of price, you can implement it in any time frame. It really doesn't matter, yeah, because price action and the time frames are fractal. Yeah, I always say it in the German mentorings. It's like a universe in a universe inside of a universe, and so on. Yeah, it's never stopping. So how you read a price action movement on a higher time frame is literally the same as on a lower time frame, but the only difference is on the higher time frame you can expect bigger moves in both directions. On a lower time frame, logically, you can't, or you shouldn't. So let's go to another random chart so I can show you. This is now in a, let's say in a 1 minute. Okay, again you see higher time frame, it's making the stairs. Yeah, it's a strong upwards push, always respecting the lows. On this case, because right here, this is not a flashy move like that. Yeah, it's not a strong big move, just more like a lot of candles with a smaller range. That means for me, the price action, the momentum, is getting weaker. Doesn't mean it's over. Yeah, we can still break it, but it's getting weaker. It's a sign for me. So what I can expect now is two options. Option one, we're breaking these lows and then going higher, or we're going straight higher. One of these two is my options. Yeah, this is a 4 hour. Now let's go down to 5-minute chart. I think it lagged. That's still not the 5-minute. I think we can't go that far behind. Yeah, okay. It's lagging somehow. I don't know why. Okay. I think something went wrong with TradingView. It shows 50-minute candles now, but nothing has changed on the chart, right? You see it? That is really weird. Let's go to the 30-minute. Still not working. 1 hour? Also not. 4 hour. Okay. TradingView is lagging. I need to refresh it. But we can still read the price action, and I'm saying we're going long here. We're going for a breakout. And this is basically the trade. Let's see. So we broke the lows as expected. And TP hit. Okay. You see, like, how often did I do this right now? And you see, like, until now, it's a super high win rate, right? Just by reading price action and understanding area points and key points. Now let's refresh. Okay. I don't know what happened now. We're at Bitcoin, but okay, that's fine. So then let's keep doing it on Bitcoin. Doesn't matter, bro. You see, price is working on everything. So this is the next one, daily. And we see super bullish move. We already retraced back and find enough buyers to keep pushing again. So it's a bullish move plus another bullish move. Even internally, it's a bullish move, you see. So that's all the conditions I need to know what the bias is. Now I hope we can switch back to the 50-minute, please. Perfect. So we have two options. and you know it. What will be the aggressive one? Right here, that's the aggressive entry. The passive entry would be around here, or even here, okay? I'm going with the aggressive entry because I know when I wait until here, this trade will never come most likely, because the move is strong, yeah? That's the job as a trader. You need to figure out and you need to read how strong the possible move can be. And how can you do it? By just looking at the market structures on the higher time frame with the internal and external points. So I am putting the aggressive entry right here. Stop loss, TP. Why the stop loss? Stop loss behind or inside where we would do the passive entries. Yeah, so we can have a pullback here. Yeah, we can have a pullback until here, but then we will break the higher highs and create higher highs. So let's see. And even, okay, I would say even if you drop below, that doesn't mean that's crap. Yeah, losses are inventable. You can't escape from losses, but what you can do is to change the overall result. If you trade it 100 times, 200 times, 500 times, yeah, then the edge will play out. And you see another TP hit, yeah, just by simply following the price action. Let's do one more example. Let's generate one more chart. Okay. Oh wait, that's a 50-minute. Let's go back to the higher time frame. Let's say 4 hours. Okay. It also looks like nearly the same. Yeah, it's like 5 years later, 4 years. So we had all-time highs here. We took the lows, another lows. From here, we started pushing and breaking all the previous highs, yeah, the internal highs. Means positive bullish movement shift. Now we officially broke this high, so that means we are super bullish. Even if we should drop sharply, I will still go long again. So in this case, we're already breaking highs and highs, but guess what? That's what I told a few minutes ago. I would go long here. Let's open 50-minute chart again. That's the 50-minute chart. Now we can do aggressive or passive entries. In this case again, super bullish higher time frame move. So passive wouldn't make any sense for me. So I'm going for the aggressive entry. Stop loss. Where can we put the stop loss? We see we have here internal low, but this can easily get broken and swept because we have a fair value gap right behind it. So we could do a try like that, where we're focusing our stop loss behind important key area points. Why is this a key area point? Because you see, this is the last big consolidation before another sharp move happened. And you know, we have a clean order block right here, and that's ruling it at the moment. Now we can still sweep it, we can still take these lows out before we're going up, but again, I am following the edge and all the experience I stacked over the last 2.5 years. So let's go. So we touched it and we broke it, stop loss hit. Now let's see how the passive entry right here would perform. That will be the passive entry. We're still not inside the trade. Let's see if it would play out. And we're right in the trade. And this would be a clear TP hit. Yeah, here you see like the differences of each entry model point. And therefore, we're talking about the aggressive and the passive one in depth in the next video. See ya.